Have you ever wondered what the difference is between a term life insurance and a cash value life insurance? Let me explain it in a way that actually makes sense. Think of it like this. Term life insurance is like renting a home. You make your monthly payment and you're protected for a certain amount of time, maybe 20 or 30 years. If something happens to you during that period, your family receives a death benefit. Here's a real life example. Let's say you're 35 years old. You have two young kids and you just bought a house. You purchase a 30-year term policy. If something happens to you while your kids are growing up or while you're still paying off the mortgage, your family receives the money to help cover the mortgage, everyday bills, and even future expenses like college. Now, here's the question most people never ask. What happens if you make it to 65 and your 30-year term ends? First of all, that's a good thing. It means you're still here. But your policy expires, the coverage ends. If you still need life insurance at that point, you'll usually have to apply for a new policy or convert your policy if your contract allows it. Here's the catch. Your premium probably won't stay the same. It will most likely be much higher. Why? Because life insurance is based on risk. At 35, you're generally healthier and statistically less likely to pass away than someone who's 65. As we get older, the chances of health issues increases. So the insurance companies charges more because the risk is greater. For example, maybe you bought a $500,000 policy at age 35 and paid around $40 a month. At 65, if you try to buy that same amount of coverage, you could be paying several $100s a month. Or you may not even qualify at all if you develop a certain medical condition. That's why it's important to think about not just today's needs, but your future needs as well. Now, let's talk about cash value life insurance. Think of this like buying a home instead of renting one. Part of your payment goes towards your life insurance protection. And another part builds a cash value over time. That cash value has potential to grow and may be available for future needs depending on your policy. Here's an example. Imagine you've been paying into your cash value policy for many years. Your daughter gets accepted into college, your roof suddenly needs replacing, or an unexpected emergency comes up. Instead of relying on high interest rate credit cards or taking out a personal loan, you may be able to access money from your policy's cash value to help cover those expenses. And if you pass away, your loved ones still receive the death benefit. Now, which one is better? The truth is, it depends on your goals. If your main concern is getting the most coverage for the lowest monthly cost, then the term insurance policy is usually the better option. If you're looking for lifelong protection while building a financial asset you may be able to use during your lifetime, then a cash value policy may make more sense for you. In fact, many families own both. They use term life for maximum protection while the children are young and debts are high, and they use a cash value policy as part of their long-term financial strategy. At the end of the day, life insurance isn't really about you. It's about making sure the people you love have options instead of financial stress when they need it most. Which one would you choose? The lowest payment today or protection that can last a lifetime?